All right, I guess we're up to the last chapter before the exam next week, huh? So let's get into chapter number 13. Chapter 13 coming up. Set this up correctly. Let me share the screen. Okay, hopefully you can see this PowerPoints now. We can go through chapter 13. It's on some metrics, and some of this we've already done. In fact, almost all of this we've done in one way or another. So I guess you could call it a bit of a summary. Learning objectives, the concept of sustainable income and quality of earnings. Sustainable income, the most likely level of income to be obtained by a company in the future. And this is different than actual net income, because sustainable income is the income they're going to earn operationally. And it's a conservative number and used in the budgeting process, okay? It does not include things like extraordinary events like the discontinuation of an operation or interest expense, things like that. Income statements provide information on sustainable income by separating operating transactions from non-operating. So sustainable is operating. A statement of comprehensive income includes net income and comprehensive income. Comprehensive income is all of the other type of income. And they're giving you a couple of examples here: discontinued operations and gains or losses on available for sale debt securities. Unusual items reported net of taxes. Disposal of a significant component of a business is called a discontinued operation. And you report income or loss from discontinued operation in two parts: the loss or gain from operations when it was part of the business, and the operation part of it can be determined, and then the gain loss on the disposal, that would be comprehensive and not part of the operating income. And during 2022, Acro Energy has income before taxes of $800,000. And then they discontinued and sold its unprofitable chemical division. And the loss from chemical operations was net of 60,000 was 140. The loss on disposal net of the 30,000 was 70, assuming a 30% tax rate on the income. Prepare the statement. And this is what we're looking at here. We have income before income taxes. We subtract out the income tax expense, and we get the income from operations. That's the sustainable. That's the income we want to see. And then we have the loss on the sale of the chemical division, along with the operation from the chemical division. Gets us down to $350,000. Stassi purchased bonds for $10,000 as an investment, which it intends to sell sometime in the future. The bond's market price was now $8,000. Now they're required to reduce the recorded value of its IBM investment by the unrealized loss of $2,500. This is the fair market value method. So you have two kinds of securities: trading securities. Unrealized gains or losses are reported in the other expenses and losses section of the income statement. Available for securities, unrealized gains and losses are recognized as other comprehensive income in stockholders' equity. So they did not purchase the investment for trading purposes, so that unrealized gain goes on the balance sheet. Now, I don't think you're going to get questions about trading securities versus available for sale, other than very basic information like this. Stassi has common stock of 3 million. Now they're showing the 3 million. Retained earnings of 300,000. and an other comprehensive loss of $2,000. That's when it was a available for sale item. And they're just showing you the total income statement, net sales, etc., down to operations, then loss from operation of plastics division, gain on disposal of plastics division, other comprehensive income. They had the available for sale security, $10,500. Change in accounting principle. It occurs when the principle used in the current year is different than the one used in the preceding year. For example, change in inventory methods such as FIFO to average cost. Changes are permitted when management can show that the new principle is preferable, but most changes in accounting principle are reported retroactively. In other words, you're going to have to restate a lot of your prior year's financial statements to make them comparable to the current one. Quality of earnings is operations. That's basically what we're talking about. Operations. A high quality of earnings provides full and transparent information that will not confuse or mislead users. Reduction of quality of earnings caused by variations in alternative accounting methods used among companies that hampers comparability. So if one company is using LIFO, another one FIFO, that makes the comparison between the two a little bit onerous. Same thing if they're using different depreciation methods. Pro forma income. Companies whose stock is publicly traded are required to present their income statement following GAAP, and they often report pro forma. These include a pro forma statement will have some estimated numbers, maybe budgeted numbers, excludes items that the company thinks are unusual or non-recurring. Analysts and investors are often critical of using pro forma income because these numbers often make the company look better than they really are. An example might be a company that had a one-time gain from a disposal of a division. And in that 1 year, they're looking great, but operationally, they're no different than they were the year before. Improper recognition of revenue. Most common abuse of manipulating earnings numbers to meet expectations, Channel stuffing, which Bristol Myers Squibb did. Bristol Myers Squibb, headquartered in Hillside, New Jersey, by the way, not far from where I grew up. Anyway, channel stuffing. Channel stuffing, let me talk about that for a second. You might find this interesting. Bristol Myers Squibb would come to the end of the month and they were short on their projections. It looked like they were not going to reach the income levels that they had anticipated. So what they did was they sent a whole bunch of products out to a customer who didn't order anything. They sent it to the customer and they were able to then claim that sale as revenue and the resulting income as income to meet their target. The deal with the customer was the customer would accept the goods and then ship them right back the next day, return them. So channel stuffing is a real fraud item. WorldCom, this was a bum down in Mississippi running a technology company. They took almost all of their expenses and capitalized them. They would have rent expense and somehow would end up on the balance sheet like it was an asset or a prepaid asset or something. And that was a big deal. And the failure to report liabilities, I can go on and on about Enron, read numerous books about it. It just fascinates me how bold and risky they were. Unusual items. In its proposed 2022 income statement, Air Corporation reports income before taxes 400, unrealized gains on available securities, unavailable for sales. So we know that's going to be other comprehensive income taxes. And then they have a loss from discontinued operation, a flour division. Oh my goodness. So here we go. $400,000 was the net income. Oh, for heaven's sake. I thought they were going to take us through this whole thing. Well, I'm not going to go through it right now. I mean, it's kind of hard to do just sitting here without pen and pencil in front of you. but follow the format that they gave us a little bit earlier up here. Pro forma, unusual items. Here we go, horizontal and vertical analysis. This is another way, another title for this chapter could be your FSA 1. This is your first FSA. They're just showing you why you were doing what you were doing. Investors are interested in core or sustainable earnings of a company, being able to make comparisons from period to period. And we could have three kinds of comparisons. There could be more than three, but we have intra-company. We're comparing ourselves to ourselves. How did we do from year to year? Inter-company, we compare ourselves to another company. How are we doing compared to a competitor? And then we can compare ourselves to industry averages, okay? So we have horizontal analysis, verticals, and then ratios. Horizontal, this is the trend analysis. This is the difference between 2021 and 2020. We're gonna go look and compare 1 year to the next. And we're trying to determine if there was an increase or decrease and express it as a percentage. So here it is right here. Current assets in 2022 were 2717. They're up from 2427. So they were up by 290, and the percentage amount that they increased was 11.9. That's all we did. This is the same exact thing we did with our FSA. We compared the 2 years together and came up with the percentage. And the formula was the formula was the current balance of assets divided by the prior year's assets minus 1 is the formula. So you've seen this in pretty good detail already. Horizontal analysis, and they're just pointing out the obvious. Current assets increased, property assets increased, 290, 174. There we go, 290, 174, 219. So that's not tough at all. Here is more horizontal analysis. Vertical. Here, we're going down from net sales, and everything below net sales is a percentage of net sales. Okay? So take a look here. We have total assets of 11,397,000. 2,717 divided into that is 23.8%. So of our total assets, 23%, 23.8% are current, so much are property and equipment, and half of them are other. That's all we're doing. We're dividing the components by the total. Here it is with an income statement. And you usually see it more, this kind of analysis, more with an income statement than you would with a balance sheet, I think. Your net sales are always expressed at 100%. Everything below it, every number below that is a percentage of the net sales. So your cost of goods sold, 6,597 divided by the 11,776 is 56%. Of course, that gives us a gross profit of 44%. We do the same thing with the selling and admin expenses. Divide it out, we get 28.1, and we can keep reducing it all the way. So 100% minus 56 equals 44, minus 28 equals 15, etc., all the way down. Horizontal, going from left to right, vertical, up and down. More vertical analysis in net sales. And they're giving us a little simple exercise to do here. Compute the amount and percentage of changes. Well, the current year is 234, the prior year is 180. So that'd be 234 divided by 180 minus 1 would give you your answer. Now they're going to talk a little bit about ratios. And we've gone through every single one of these ratios in this course so far. So this is a little bit of a repeat and review. And we have different ratio classifications. Liquidity measures short-term ability of the company to pay its current debts. We have profitability, or is the company making money operationally? And solvency, are they good for the long term? A single ratio by itself is not very meaningful. You can have intra-company comparisons for 2 years for Chicago Serial. You can compare them to industry, or you can compare them against a specific competitor. And these are the ratios. And I'm not going to go into detail on most of them because we've gone through these already numerous times between your FSA and your homework. Working capital, current assets minus current liabilities, the current ratio, current assets divided by current liabilities, inventory turnover, cost of goods sold divided by the average inventory. We can turn that into days by dividing the turnover into 365. Accounts receivable turnover. You take the net credit sales, divide out by the average AR, and then you can turn that into days. So those are they're calling those liquidity ratios, okay? Short term. Solvency. How much debt does the company have compared to assets? Liabilities divided by assets times interest earned, net income plus interest expense plus income tax expense divided by interest expense. I don't think we went over that one too much. So that's a new metric there. It's showing what kind of income they have above their interest expense. It shows you how much they're financing the business by paying interest. And we did this one really back in chapter 1 or 2. Net cash provided by operating activities minus capital expenditures minus cash dividends. And then we got some more earnings per share. These are the profitability ratios, okay? Earnings per share. You divide your net income, you pull out the preferred dividends because that amount has to be set aside for them. And you divide by the average outstanding shares to get the earnings per share. Price earnings ratio, the PE ratio, market price compared to earnings, gross profit rate, profit margin, return on assets. None of this should be too unfamiliar. Asset turnover, sales divided by total assets. The payout ratio, cash dividends divided by net income, and then the return on common stockholders' equity. Again, net income minus the preferred dividends divided by the common stockholders' equity. So those are ratios to refamiliarize yourself in preparation for the exam. And they're just showing you the different statements we can use. Nature of liquidity ratio. Liquidity ratios typically are short. Talk about the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. Interested in assessing liquidity, short-term creditors, bankers, and suppliers. You want to borrow a little bit of money from a bank, they want to make sure that not only you can pay it back, but you'll be able to pay it back quickly out of your existing working capital. And they go through, and now we go slide by slide on how to do these ratios. And I'm just going to show them briefly. You've gone through these. If you have any questions on them, you can always text me or email me. But you've been through this, you've been around the block on this now a couple times. The average collections, inventory turnover. Then we get into the solvency ratios. Debt to assets, that's always an important one. How much are we financing the business? Times interest earned. Shows you how much they're financing and their ability to pay their interest expense. Free cash flow, we went over this already. It's the net cash from operations minus capital expenditures and cash dividends. In other words, operationally, we put together a pretty good amount of money, but we want to set some aside for dividends and set some aside for capital expenditures, meaning we're going to be investing in equipment in the future. We want to set that money aside. What's left over is the free cash flow. And the profitability ratios. They're just giving you a little tip here. Return on common holders' equity, return on assets, profit margin, asset turnover. Profit margin times the turnover equals the return on the assets. And we'll show you here in a second. Return on common stockholders' equity. Again, we pull out the preferred dividends. Return on assets, income divided by total assets. Profit margin, income divided by sales. Asset turnover, net sales divided by average total assets. And then they're showing you a little formula here. Net income over sales, net income over sales times the turnover gives you what's called the total return on assets. Gross profit rate, earnings per share. This was the very first metric we learned, I believe, when we took out the net income and we subtracted the dividends for the preferred people before dividing by the earnings per share. Payout ratio, it's just the cash dividends on common stock over net income. That's an interesting one, huh? If a company had $2 of net income, it'd be interesting to see how much of that they gave away back to their investors in the form of a dividend. And then they go into the international world, which we don't bother with here. And that is a quick look at chapter 13. So you can see a lot of this was a review of metrics that we've already reviewed. So take a look at all those, make sure you can do them pretty easily. None of them are particularly tough. You should be very good with the FSA section where they were doing the horizontal and vertical comparisons. So I will leave you there. We didn't get anybody to join us today. So I will leave you with that note. Good luck on the exam. I would love to have you in my 240 class starting next semester. And again, best wishes, and I hope someday to actually meet some of you rather than just going through the Zoom meetings, which frankly, I don't like. I wish we were on campus, unmasked and ready to go. And we'll get there someday. You take care, everybody.